Morning, everybody. It's Yardeni here, and delighted to have Eric Wallerstein join us today. Eric joined us about 3 weeks ago, right, Eric? It was May 7th, I think it was.
Yep, a few weeks.
Eric had been ace reporter, journalist at the Wall Street Journal. I was always impressed with his front cover and stories, and he also had other stories that didn't make the front cover, but his front cover stories were always fascinating and seemed to be very well researched and well thought out. So now I'm pleased to have Eric's skills and talents on the Yardeni research team. Eric also, what I liked about Eric's background is he spent some time at the Federal Reserve Bank of New York, which is where I started my career. So we were kindred in spirits in regards to our joint experience at the Fed. I told Eric that when I was at the Fed, Paul Volcker was in charge, and Volcker and I were on first name basis. He called me Ed, and I called him Mr. Volcker. But after I tell that joke, and then I honestly say that actually I don't think we ever spoke, and I don't think he ever acknowledged my existence. I was just a lowly staff economist operating in a room without a window and shared it with somebody else, writing very short memos about the savings and loan industry, which is about as boring a topic as you could get in 1979, 1980. Turned out to be really a good background to have when the S&L crisis broke out. But Eric, what was your experience there at the Federal Reserve Bank of New York? They didn't put you in an office all by yourself today?
No, I was on the floor with the rest of the desk. So I was covering repo and money markets right before the repo market decided to freak out, and then COVID happened. So I both fortunately and unfortunately was in the middle of all of it. But it was a great experience, and I learned a ton about those markets.
So you kind of saved the day for us, right? You came up with all those emergency facilities there on, what was it, March 29th, 2020, when everybody was thinking the world was going to come to an end, and you came in with your open market desk and announced all these wonderful plans. But anyways, I thought that was a great experience back there, and Eric knows a lot more about the fixed income markets than I do. So again, that's a good addition. I have been asked a few times, what is Eric going to be doing? And the answer is everything I'm doing, everything Jackie Dougherty's doing, Melissa Tagg, Debbie Johnson. We're a team, so we're all writing about different things at different times, and sometimes about the same things at different times. So, for example, Jackie has written stories on China, as I have. Eric, you recently wrote a couple of stories for us. Well, one was on the deficit, which you have a lot of background research on, and another one was a consumer. I guess the insight I got from you on the deficit, which I wasn't aware of, was exactly who was financing it. What? Just tell us a couple of things what you found.
Yeah, so there's shifting demand. A lot of people talk about, the treasury. Will people really want the bonds? There's always someone to buy the bonds. It just matters what price they want them at. Where is that market going to clear? One thing we found is foreigners, of course, they love U.S. treasuries. It's a safe place to park their capital, and they've been a very sort of steady source of demand for the past few years. Very interesting thing is that money market funds have bought quite literally trillions of dollars of treasuries. That whole COVID stimulus spree, money market funds are really the ones who stepped in as the marginal buyer when the Fed stepped out and started doing QT. Now, it's interesting because money market funds can only really buy treasury bills with maturities of a year and in. So if the treasury has to term out their debt and start issuing long-term bonds, it'll be interesting to see who steps up as the big buyer, with the Fed absent and foreign buyers kind of around a steady rate throughout the past couple decades.
But as we learned on November 1st of last year, the Treasury has some smart people, and they know that they're plugged into the markets. They have a committee that advises them, and I guess what the committee came up with, or Janet Yellen came up with on November 1st of last year, was basically telling the bond market, if you don't like our notes and bonds, we'll just do it all in bills, right? That seemed to be the message.
Yeah, so the Treasury flip, they usually try and keep around 15 to 20% of all treasuries in bills. That's gone above that. It's to 22, it could even go to 23%, once the Treasury starts issuing more next year. What's very interesting to me is that Governor Waller at the Fed suggested about a month ago, maybe the Fed should hold more bills than coupons and bonds. And actually, this morning or last night, Governor Bowman suggested the same thing, that the Fed should be more of a bill heavy institution. So yeah, I don't think the Treasury necessarily will wean away from this kind of bill binge they've been on. And yeah, it'll be interesting to see how that progresses. But it could be the way they start issuing debt from here on out if the long end of the curve is a little testy.
Yeah, since you're quite good at researching these things, I ask you to also take a look recently at the consumer. You were looking at consumer credit, consumer debt. There have been a lot of headline stories about the consumers cracking, a lot of stories about the low-end consumers under stress and maybe starting to see increasing delinquencies. I've been basically pushing the idea that demography is very important and that the baby boomers uh, have been doing a lot of spending as they're retiring. But what did you find when you kind of cracked into the consumer and looked at what's going on the debt side?
Yeah, there was a lot of focus on credit card delinquencies starting to rise. Honestly, it feels like people who have been waiting or looking out for a recession for the past couple of years kind of jump at any data point that might support that. What we found under the hood was that it's just maxed out borrowers, those who use 90 to 100% of their credit limit, were starting to go delinquent. But when you look at that cohort, there's actually less people who are maxed out as a percentage of overall borrowers than there were before the pandemic.
Mm.
So there's fewer maxed out borrowers. They just happen to be going delinquent. If you think about where credit card rates are at, they've gone from 15% to 22%. Those people are just going to go delinquent quicker. That's all we're seeing. Actually, broadly, the consumer is a lot healthier with regards to their debt levels. And you can see it in debt service payments relative to disposable income. People can finance all that borrowing. It's under 10% for the average household of their debt service payments to disposable personal income. That's, if you outside of the COVID aberration, that's an all-time low. So we think the consumer is doing just fine. Real wages for lower to middle income cohorts are rising. So the whole K-shaped recovery notion, of course, higher income cohorts are supported by asset prices and homes and stocks have been rising, but the bottom is doing just fine, and they're benefiting over the past couple of years. So we don't think the consumer is cracking, and we kind of reject the whole K-shaped
Yeah.
recovery thing.
The consumer confidence data came out this morning, and we did see a slight downtick in jobs available.
Hmm.
Um, uh, but what's interesting is we didn't really see a comparable increase in jobs hard to get, which I think is still in the low teens. It turns out that what increased is sort of that middle category that jobs aren't hard to get, they're not plentiful, it just takes a little bit more effort to maybe find a job. But all in all, it certainly still that series still suggests that jobs are available and the consumer isn't about to run into real problems finding jobs. And you and I have been looking at continuing claims as a good weekly indicator of the jobs market. I think at the bottom line of it all is that if you want to get a good read on the labor market on a weekly basis, the only thing we really have, and it's pretty good, the data is initial claims and continuing claims, and they both suggest that on the employment side, there's still plenty there. Eric and I are also working today for tomorrow's morning briefing on the story about another story about the idea that the economy is more resilient than a lot of people appreciate. there's still some diehard hardlanders, as I call them. There's hardcore hardlanders, whatever adjective you want. They just won't listen. They won't give up. I know that there's a couple of people that are pretty vocal and visible about the fact that we're in a recession right now, in their opinion. And then one of our competitors, who's very highly regarded and rightly so, she's saying that recession is coming. And one of the factors that she's pointed to, which Eric kind of alerted me to when we kind of each looked at a podcast of this fine lady, is the notion that SLOOS, this senior loan officers opinion survey that the Fed puts out on a quarterly basis, that's showing that credit conditions are tightening. And Eric pointed out that well, the problem with SLOOS is it's all about the banks, and the banks just aren't playing as big a role in our financial markets. There's more private equity, private debt, and so on. So we wrote about that. And Eric, you kind of segued that idea into goods versus services. That the economy is less interest rate sensitive. It's less sensitive to whether bankers are willing to lend or not, or what they're charging. And one of the reasons it's less sensitive is something that we've all known, that the economy has moved to more services relative to goods. But we kind of put numbers to it, and the numbers are pretty dramatic. What were some of the points that you observed?
Yeah, I think one of the key points is that, I mean, first of all, manufacturing is a very capitally intensive business. It requires a lot on financing, thus it's interest rate sensitive. But if you look at employment, all goods producing industries, so manufacturing and construction, is down to just 10% of non-farm payrolls. It was above 30% decades ago. So if you're interest rate sensitive, employment is just 10% of the overall picture. Of course, the labor market can remain, sound with rates at 5 or 5.5%. You can see that across categories. A lot of industrial spending and investment is in the high tech segments of the economy. So R&D, intellectual property, these things have been soaring. Well, if you think about where goods have been, I mean, we import a ton of goods, and that's where a lot of our consumption is. Plus, we're just consuming less goods than we are services. Goods consumption topped out a few years ago, and it has kind of plateaued at those record highs, while cohorts like baby boomers demand services. There's healthcare has become a huge part of both consumption and employment, travel, both airlines, hotels. That's where things are rising, and that also helps boost employment in those industries, which is where low and middle income cohorts kind of see their real wages rise. So it's no surprise that raising the Fed funds rate isn't affecting the economy as much, especially after all these companies and households termed out their debt in 2020 and 2021 and locked in all those mortgages and long-term bonds.
Well, so a natural evolution of the research that we're doing is to then consider the question of whether the interest rates need to come down. There's a big debate about R star, which I always thought was a bit of a phantom variable. You can't really measure it, so you can only talk about it. And I always thought there was ex post rather than ex ante. That's the only Latin I remember. But ex post meaning that you don't really know where R star is until you see that the economy is doing well and inflation is fairly moderate. And I think that describes the current economy. And I know there's some people that still view it as stagflation, but it looks like pretty good economy with the unemployment rate below 4% for 27 months, with inflation, in our opinion, continuing to moderate. We think that opinion will be corroborated by the personal consumption expenditure deflator later this month. So it looks to us as though the economy has demonstrated that it can handle these interest rates. The stock market's demonstrated it can handle these interest rates. As you folks know, I've been arguing that there would be a mistake for the Fed to lower interest rates. Let's say the unemployment rate suddenly gets all the way up above to 4.1%, first increase above 4% in 28 months, and everybody gets hysterical about it. And the Fed says, oh, we got to lower interest rates. Then we're talking about a 1990s melt-up scenario. And it's great on the way up, but melt-ups usually are followed by meltdowns. So, Eric, have you started to look at the R star? I know you looked at it before, and didn't one of the Fed governors just give a whole speech on R star?
Yeah, Governor Waller decided to take a break from the short term and opine on the long term. I guess he cited a lot of reasons why R star might have kind of fallen over the past few decades to very low levels during after the great financial crisis, and why it might be rising today. Essentially, what it is a story of like, where are secular inflationary pressures coming from, and where is demand for treasuries. So foreigners had a lot of demand for treasuries over the past several decades, including China when they joined the World Trade Organization. The U.S. runs a huge trade deficit, and that needs to be financed somehow. And thus, people go buy our treasuries, which are also a safe haven. He looked at the volatility of our monetary policy and our economy. I think it makes a lot of sense just to think about, okay, the US stock market has done so well over the past however many years because the economy has been so strong, and it's really been dependent upon, especially during times of stress, that naturally creates demand for our assets, which lowers yields and raises prices. So why might it be rising today? Well, there's a demographic question. Is the economy a little more inflationary going forward? The fiscal deficit doesn't look like it's going to be solved anytime soon. That's actually how he left off his speech. Like Washington needs to figure out the fiscal side of the equation. Janet Yellen echoed that a few days ago. So I don't know. All in all, what it really means is long-term rates are where they are, around 4.5% on the 10-year, and there are pressures kind of pushing that up and pushing that down.
Right.
As far as policymakers are concerned, maybe they have to keep rates a little higher for a little longer, but 2 to 2.5%, impacts the 10-year yield, 0 to 50 basis points.
Yeah, look.
So it's not a huge deal.
Yeah, the other issue is, how do you even measure the real rate if you want to try real hard? I mean, does it really make? It seems to me Fed officials talk about the real rate as though it's the Fed funds rate minus the inflation rate, which seems very curious to me that you have a real rate, which is an overnight rate less the year-over-year percent change inflation rate. I don't know anybody that makes their economic, business, personal finance decisions based on the real federal funds rate. Maybe the real bond yield makes a lot more sense. So those are some of the issues we'll be looking at for next week that Eric's working on, and I'll be working on it with him in that area. One of the things that Eric recently alerted me to is, like everybody else, I thought that Eric was mentioning foreign buying of treasuries, and a lot of people ask me on a regular basis, well, aren't the Chinese selling? And when you look at the treasury data on Chinese holdings, what did you see there, and what was your insight that I wasn't aware of? It has to do something with chocolates.
Yeah, no, a lot of people panic that China is selling treasuries or not reinvesting into them, and somehow that'll cause the dollar to lose its de facto currency status. Those warnings are all overblown. One of the things that recently came up was China starting to build gold within its reserves, and it's now at an all-time high. Around 5% of or 11% of their foreign reserves are in gold. But yeah, they're actually not selling treasuries, most likely. And the reason is China kind of keeps a lot of their treasuries in Belgium.
With the chocolates.
And chocolate specifically. If you look at the data, as Chinese holdings of treasuries have decreased, Belgium's on almost a one-for-one basis have increased because there's a large custodian there. And there's actually reason to believe that they may be diversifying their custodians into both Luxembourg and the UK. Luxembourg and Belgium have competing custodians, and the UK is a large hub for that. So we think that the demand for gold makes sense, especially when the US has sanctions on Russia. It makes sense to diversify some of your reserves into something that can't be frozen. But yeah, no, there's really we don't see anyone losing their demand for treasuries. And if so, the Fed wouldn't need to have facilities to pump the world with dollars whenever there was a crisis, like in 2020.
Well, Eric, thanks. Hang on. Why don't we look at a couple of charts? One of the reasons we had some good time here to have a discussion with Eric. Is there aren't that many charts in the morning briefing this morning, but we would certainly, even if we had more charts, I did want you to meet Eric, and you'll have plenty of opportunities to read his research and interact with him. We'll probably get on the road and introduce Eric to some of you in some of the cities that we have a lot of accounts in. So we're really excited about that. Look forward to it. Let's share the screen here, and let me see where I want to go here. I think I want to go there. Okay, so this is the chart collection from this morning. This morning I discussed the big issue that I think is the number one risk for the stock market, the U.S. economy, the global economy, and that's geopolitical in nature. And there's a lot moving parts right now in the geopolitical realm that could potentially go wrong, but so far that hasn't been the case. I think when you look at geopolitics historically, and I could use some help on this, so please chime in. It seems to me that there are two kind of events that could really impact the global economy and global stock markets. One, as we saw in the 1970s, is geopolitical events that cause the price of oil to soar. When the price of oil soars, that tends to feed inflation because oil is so important. It could feed a wage price spiral, as we saw in the 1970s, and it could force central banks to raise interest rates dramatically in an effort to bring inflation down. And what they're really trying to do in that scenario is cause a recession, because what central bankers know is that when you've got an out of control inflation situation, the only sure way to bring inflation down is with a recession. I would argue that even in the current case, that's worked. However, we didn't really have to have a recession in the United States to bring inflation down. It was good enough to have a recession in China in their property market so that they had to export more and sell and export more deflation. So maybe the idea that recessions one way or another are the only way to bring inflation down still even holds today, though we've been arguing that the U.S. inflation rate could come down without a recession, and so far so good in terms of that forecast. So one of the ways that geopolitical events can cause recessions and bear markets is by disrupting the supply-demand situation in oil in a way of causing oil prices to spike up higher. The other way, I think, from history shows, is to create trade wars, major protectionism. And the Smoot-Hawley tariff comes to mind. Trump, of course, during his first term, we'll see whether he gets a second term or not. And we'll see whether that, well, never mind. I'm not going to go political. So Trump imposed some tariffs on China. That didn't really cause a recession. That did cause some global slowdown as we saw. But overall, it wasn't the kind of trade war that caused a recession. The clear-cut example is the Smoot-Hawley tariff. And here in Figure 1, you can see we have the S&P 500 going back to the 1920s. And you can see we had this roaring 1920s bull market. Maybe we have some similarities to the roaring 2020s bull market. And whenever I make the comparison to the roaring 2020s, people come back at me and tell me, well, yeah, but it ended badly. And, I can't tell you what's going to happen in 2030 or 31 exactly. I have my ideas that prosperity will continue, but maybe something will go wrong. But in this case, what went wrong is the government imposed a prohibitive tariff that basically shut off world trade. And the so-called Great Crash, I think the market, if you look at this little area here, bring a magnifying glass with you next time, and you'll see that there was a crash there in late 29. But during early 1930, we actually regained 50% of what we lost. So it was not really that big a deal. The big deal was the great crash that followed the Smoot-Hawley tariff, as you can see here. Um, then let's look at the history of other geopolitical crises. When we do so, and I'll let you do this on your own, you can see that more often than not, geopolitical crises tended to be buying opportunities. Look at even in World War II. Here's what happened with Pearl Harbor. Yes, the market went down, but it actually made its low after that. And I think it was a few months later that America remarkably got its act together and beat the living daylights out of the Japanese Navy in Midway. And that actually made the bottom in the market. I guess the market started to figure that America was going to rise to the challenge and win the war after all. But anyways, clearly the war effort led to a tremendous amount of spending, and manufacturers were at full capacity. And so the stock market rallied pretty dramatically here. And then again, you can look at all these other crises and see that more often than not, they did create an opportunity. Russia invaded the Ukraine. Well, in that situation, we actually had a bear market. So it was a buying opportunity, but it was a painful one if you started too early. But it wasn't a very long bull market. It's a bear market. It started in January 2022, and it ended in October 12th of 2022. That's not terribly long, but it was a 25% drop. But even within that bear market, I think there were only 7 trading days, or just a handful of days, where you were actually down more than 20%. So it was kind of more in correction territory than it was in bear market territory. Though I know we all lived through it, and that was not the case if you were heavily in tech. I mean, clearly that was a painful experience. But November of 2022, we suggested that we had made a low in October, and that turned out to be correct. I think we've demonstrated we're pretty good at calling bottoms. I'm still working on tops, but I'll let you know when I think we got the next top. But here we have the Hamas attacks Israel, and then I and everybody else got concerned that this could become a regional war, and it's sure enough. Was a few weeks ago, Israel and Iran exchanged missiles with each other, and then it all kind of got de-escalated on that front. Anyways, the war is still very much going on between Israel and Hamas, and yet the stock market's basically at an all-time record high, and that's partly because the price of oil has come down. It looks as though the premium, the war premium, the geopolitical premium on oils, it was about $10, and that's come down, and that's given a lot of relief to the market. Well, now Biden and Trump do have something in common, believe it or not, and that is their commitment to slap tariffs on China, and that may be the beginning of a tariff war, a trade war. Melissa Tagg, also on our team, just wrote a piece on Mexico that'll be in the morning briefing tomorrow, pointing out that guess what? The Chinese are investing a tremendous amount in Mexico to produce what they might have produced in China, producing it in Mexico. Well, let's open it up, see if there's any questions on the Q&A board here for Eric or myself. Let's see what we got here. Is your Denny research a hard hat area? And if so, as Eric has a safety briefing. I'm not quite sure what that quite means, but anyways, I think it means, maybe the Wall Street Journal was a more leisurely, relaxed place than your Denny research. Any comments on that, or you'd rather pass?
I'm going to pass.
Okay, good. Okay. Any other questions for us? That was the only one. And I guess you must have been mesmerized by our conversation. And maybe you got annoyed because Max isn't here today. My wife is home, and Max likes to spend time with her more than with me. So we'll give it a rest unless I get one more question here. Anyone with a question? Oh, here we go. Why during? No, I don't get that question. So I'm getting,
The Smoot-Hawley tariff, perhaps?
what's that?
The Smoot-Hawley tariff.
Oh yeah, yeah, yeah. Okay, go ahead. Oh yeah, why during Smoot-Hawley tariff? Yeah, I didn't know what SHT meant. Thanks. That's why Eric's such a great team member. Is he helps me decode a lot of stuff. Um, Oh, this the Smoot-Hawley tariff has sort of been a pet theory of mine that I don't think should be controversial, but it is controversial. A lot of economists have all sorts of different reasons for what caused the Great Depression. But I think when you shut off world trade, which then caused grain prices and other commodity prices to collapse, and then the banks have loans to a lot of these farmers, that the whole thing kind of implodes. Um, I don't think the Fed was uniquely responsible for the Great Depression. There's certainly it had of its policies that contributed to it. But then what got us out of the Depression was Cordial Hull, the Secretary of State, negotiated some easing of those tariffs. And in addition, FDR got us off the gold standard, basically, which kept the Fed maybe more tight than they should have been. But Smoot-Hawley is my explanation for the Great Depression. Oh, and then Chip followed that up with 20,000 tariffs. I wasn't aware that there were that many tariffs, but there were some pretty humongous ones. Okay, Lucas, what do you think happens until payrolls, rates, and equities? Oh, until payroll employment? Um, well, payroll employment's probably going to be another decent number, not a out of the park, you know, home run, but I would think 150 to 200,000 is something that we might be able to get out of the payroll data. Uh, Expect wages to be up again, maybe outpace inflation. Um, so in terms of rates and equities, we're sticking with our 5,400 on the S&P 500 by year end, even though we're already at 5,300, thinking that the market may still have some indigestion here with the idea that the Fed isn't going to be lowering interest rates anytime soon. So, in terms of equities, we're in a bull market, and in terms of rates, rates have normalized. Okay, Chip, thank you. He says yes. Michael, is there any one factor that causes the dollar to decline? You want to chime in on what you think might cause the dollar to decline, Eric?
Yeah, I think if the Fed finally comes around to this idea that they need to cut interest rates to keep the inflation adjusted rate in the same realm or in restrictive territory, that's when we'll start to see some weakness. Um, but until then, and especially if global central banks like the ECB or the BOE begin to cut, the dollar should remain pretty buoyant.
Let's see. Isaac says, do you foresee a downgrade of the U.S. credit rating as a medium-term risk? I don't. I mean, we had one already. Eric, you see anything? I mean,
No,
we don't really
um,
know. I mean, we don't know Moody's. We don't know how the credit rating agencies are going to respond here. But if I mean, somebody at the credit rating agencies got to know that if the Fed's going to do it all in bills, that's not going to be very hard for the Fed to finance, right, Eric?
yeah, the ratings agencies kind of lag. So like it wouldn't be because they downgrade, it'd be for the reasons why. And one of the things that they're worried about is political instability, like the if debt ceiling resolutions continue to, come at like the last hour, that's a worry. And then the fiscal deficit, which everyone seems to be worried about. So
Okay,
that's
we'll ask. We'll end with a question from Doak, and that is, Eric, what is the chart on the wall behind you? If unless you don't want to comment.
no, it's booms and busts over US history. It's from like a early mailing agency. So it ends around like World War II, I think.
Eric, it sounds like you need to get a life. I don't have any charts on my walls, but that's good, and I'm glad that you've got some good artwork like that on your wall. So look, everybody, Eric and I look forward to working with you, as does the rest of the team. Jackie, Melissa, Debbie, Molly, David, um, Sandy. I hope I didn't miss anybody. Jackie, of course. And we'll see you on a weekly basis as usual. Thank you.
Thanks, everyone.
So